Welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been researching life insurance and real estate investing, you've come to the right place, so be sure to like and bookmark this channel right now so that you don't miss any of my content and you're able to go back and search all the old content. Today, in this video, I'm going to be dredging up some old content that I shot over 2 years ago, recorded over 2 years ago, and I should have gotten out much sooner than now. This topic is very important. It addresses the myth of, will the rising cost of mortality cause an indexed universal life to lapse? And this is a myth that pervades the life insurance space. I mean, you really just can't do any kind of research into indexed universal life without coming across this myth. So if you want to find out why this myth is not true, stick around after the intro and we'll get started with my old content.
All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and the goal of this video is to show you that the costs of mortality in a life insurance policy are the same for both whole life and for indexed universal life. And people who tell you that the rising cost of mortality in an indexed universal life are going to cause that policy to lapse don't truly understand how the policies work under the hood. So what I'm going to show you is that both types of life insurance policies, whole life and IUL, face rising cost of mortality. I'm going to show you how both of them deal with that rising cost of mortality. Then I'm going to go further and show you why an indexed universal life actually has lower risk than a whole life. And then finally, we're going to take a look at maximum overfunded policies and really show you that this myth just can't possibly be true when you're talking about a maximum overfunded cash value life insurance policy, which is what we need for the double play. All right, so if you're interested in taking a look under the hood of a permanent life insurance policy, finding out how it works and why this myth just can't possibly be true, stick around. I've got to take care of a few housekeeping items and then we'll get started. All right, let's take care of some formalities first. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, before we get started, please, if you find my content valuable, please go down and click on the subscribe button so that you're notified whenever I come out with new videos. Be sure to like this video so that it shows up higher in the search results and other people can benefit from finding it when they're searching on this topic. So, all right, let's get started. So the first thing I want to have you understand is exactly what the cost of mortality represents. When somebody's talking about the cost of insurance or mortality costs in a policy, what are they talking about? And it's important to understand that all life insurance is about the pooling of risk. So the easiest way to get your arms around the cost of mortality is to think of a one-year term policy. An insurance company is writing a one-year term on a $1 million term policy on a 45-year-old. The important thing for the insurance company to know is what is the risk of a 45-year-old not making it to 46. So out of all the 45-year-old insureds that they have policies on, how many of them are going to pass away that year, where they're going to be required to pay a claim? So what the cost of insurance represents, or the mortality cost, that's the amount of money that the insurance company needs to set aside into a pool in order to pay all of the expected claims, still make a little profit, and perform on the obligations of that policy. So a 10-year term is just simply the sum of the 10 one-year terms. What's the risk of that person making it from 45 to 46, or not making it from 45 to 46, from 46 to 47, and so on for 10 years. So how much do they need to take in premium in order to pay the expected claims if that person were to pass away in any of those years? Now, that's term, and term is very easy to get your arms around. But in a permanent life insurance policy, it's important to understand that the insurance company knows it's going to have to pay a claim someday. And the way that they account for that is there's the cash value, which represents essentially the policy owner saving up the death benefit over the course of the insured's lifetime. So there's a slow but steady risk transfer. In the early years of the policy, all of the risk is on the insurance company because the cash value portion of the policy is very low. But over time, as the cash value grows, there's less and less risk in the policy that the insurance company needs to cover. So the risk is transferred over to the policy owner. So if they live to be their natural life expectancy, they will have saved up essentially their own death benefit. So this is a graph that I like to use for explaining how a life insurance policy works. And mind you, at this point in the discussion, we're talking about how life insurance works. I've made no distinction whatsoever between IUL or whole life. This is how any life insurance policy works, any permanent life insurance policy. So what I'm showing here is a policy on a 45-year-old with a $1 million death benefit. The orange line at the top represents the death benefit of $1 million, and the blue line represents the cash value of the policy. So if you think about it, the insurance company is collecting premium dollars, and some of those premium dollars are going into the cash value, and some are being put towards the cost of insurance, which, and if you look at year one of that policy, there's very little cash value and a very high death benefit. So if the insured were to pass away, the insurance company would have to pay that $1 million claim. So they need to set aside enough money in the pool to pay that claim. Now, on a 45-year-old, the risk of passing away is very low, so the cost of insurance is very low as well. But as you move along that graph, you can see that the cash value is accumulating. So even if the cost of insurance is rising, and the reason for the cost of insurance rising is that if we go out to age 80, for example, the risk of an 80-year-old not making it to 81 is much higher than it is for a 45-year-old not making it to 46. So that's why the cost of insurance rises as the policy insured gets older. But what everybody fails to mention is that the cash value is offsetting that higher cost of insurance. So if you understand how the policy works, you'll understand that the net amount at risk to the insurance company is going down each year as the cash value is increasing. And it's important to understand that you can see that the insurance company has an incentive for the cash value to grow as quickly as possible. So the main takeaway from this first part of this is that all life insurance policies face rising costs of mortality. And they deal with that rising cost of mortality by including a cash value portion of the account, which is really the policy owner saving up the death benefit for the insured. So whether it's a whole life or an IUL, both types of policies face rising costs, and both policies deal with it through the savings mechanism built into the policy. So now that we've got our arms around that, the second main takeaway that I want to explain to you is that in an indexed universal life, the costs are actually going to be lower because the cash value is going to grow at a much faster rate. So what I want to do here is I want to explain what's going on under the hood. What is the insurance company doing with the money? So the insurance companies, the cash value doesn't sit idle during that time. The cash value goes into the general fund of the insurance company, and they invest in bonds, U.S. treasuries, corporate bonds, municipal bonds. They buy tons of mortgages off the banks. They buy preferred stocks. They invest in real estate. They make loans themselves. And at the end of the year, they earn income on all of those investments. And in the case of a whole life, and this is where whole life and IUL really differ, is in a whole life, that gain on the investment account is allocated to each of the policies and credited as a dividend. So you can think of the dividend as being the return on the cash value portion of the policy. So in a minimally funded policy, for example, you've got very little cash value, so your dividends are going to be much smaller. But in a maximum overfunded policy where you've got a tremendous amount of cash value, your dividends are going to be much higher. Now, what's different in an indexed universal life is the insurance company is taking that income, and instead of crediting it to your cash value as a dividend, they're going out to the index options markets and they're hedging to try and capture as much movement in the market index as they can get with the money that they have to spend. And the budget that they have to spend is dependent upon what the interest rates in the environment are. So today, in the late fall of 2020, interest rates are extremely low, and that's reflected in the caps offered on Indexed Universal Life. Because the insurance company is making less money on its money, it's got less money to spend on hedging, which means it can't buy as much movement in the market, so the caps end up being lower. Years ago, just a few years ago, the caps were as high as 12 and 13%. And that's because interest rates in the environment were higher and it gave them more budget with which to use to purchase options. And they were able to capture much more movement in the market. So that translated into greater returns on Indexed Universal Life at that point. So what I really want to point out at this point is that the goal of an Indexed Universal Life is not to match the performance of the underlying index. It's simply to capture a premium over the debt market rate of return. So the point of all this is to have the cash value grow at a faster rate just by earning a little bit of a premium over what they would have earned had they just simply paid that dividend to the policy in a whole life. So I'll spend a little bit of time on the hedging itself. So the insurance company, again, their goal is to capture as much movement in the market index as they can get with the money that they have to spend. So they're buying options, and the options have a strike price. So they're trying to find a strike price as high above the current market value as possible to lock in as high a cap as possible. So if the market index goes up beyond the strike price of the option, I just want you to understand that nobody captures that. It's often thought that the insurance company is taking any gain above the cap, but that's not really the case. That's the strike price of the option. So that's where the trade is executed, and the settlement amount is basically credited to the cash value of the account. If the value of the option itself goes up, if the market index goes up above the original buy-in price. So that's when you get the return that the market got between the floor and the cap. That's how that's determined. And the reason that you don't lose any money is that if the market index goes down, the option simply expires worthless. So you may have lost the dividend that you could have received that year, but you didn't lose any cash value because the insurance company is not investing in the market itself. They're just simply taking the money that they would have paid as a dividend or credited as a dividend, and they're using it to purchase options. So with an IUL, you're basically trading the safety and security of earning that dividend year in, year out for volatility of returns, meaning you could have a 0 and you could have a 10 or 12 or more % return. So what I want to do now is just illustrate what higher returns mean for the cash value of the policy. So let's go back to the graph of a minimally funded life insurance policy and note that if the cash value were to grow at a faster rate, the gap between the death benefit and the cash value would shrink, meaning that there's less risk in the policy. So the insurance company has an incentive for the cash value to grow as quickly as possible. So with an Indexed Universal Life, the insurance company has the ability to basically capture a premium over the debt market rate of return. So how much of a premium can we expect in an IUL? So in this chart, I'm showing 30 years of S&P 500 changes from year to year. And I'm basically applying the formula for an Indexed Universal Life. So what I'm trying to do and illustrate here is show the growth of $100 over 30 years in time and calculate the average annualized rate of return for different time periods. So I'm looking at the growth of $100 as if the individual had invested in the market index with cash, and it's just a simple illustration. It's not meant to be a financial projection, but it's just With no fees and expenses, if you earned the change in the market, this is what $100 would have grown to over 30 years. And then I'm also applying the formula for an Indexed Universal Life. So if we input a user-definable cap and a floor of 0, we can determine over that period of time, had the cap been at 9%, we can estimate what, not you can't estimate, that's what an IUL would have paid had the cap been 9% for 30 years. So keep in mind that the caps change year to year based on the budget that they have to spend, right? So interest rates in the economy do change, and the insurance companies do change the caps on the policies to keep up with what they're making on their underlying general fund. So here, over 30 years in time, we're simply projecting out what that $100 would have grown to. So if we take a look at that, what I'd like you to notice is just eyeballing it, you can see that roughly 1/3 of the returns are zeros. So out of every third year, it averages out to be about every third year is a down year in the market. But look at the other 2/3. You'll find that there are very few years where the returns actually come out in between the cap and the floor. So it's either at the floor or it's at the cap. Now, clearly, if the cap went up, we'd have more returns showing up in that delta or gap between the floor and the cap. But you can see that it's usually one or the other for the most part. Now I'd like to direct your attention down to the bottom of that table. And you can see that I've got annualized returns shown for 5, 10, 15, 20, 25, and 30-year periods. And I want to take a minute and just explain what an annualized rate of return is, because there's a little bit of, people like to talk about the sequence of return risk. They say that when they're trying to be smart, essentially. But annualized returns take into account the sequence of returns. Annualized returns are not average returns. So what an annualized return is if we look at that $100 when we started and where that $100 is 30 years later, we can calculate what the rate of interest would need to be for it to grow from $100 up to its ending value. And that would take into account all of the ups and downs, the years of zeros, the years of caps, in between there. So the annualized return takes into account the sequence of return risk. So now what I'd like you to take notice of is, even with a cap of 9%, you can see that the returns range from the low fives to the upper mid fives. And so in this chart, you see that the IUL forecasted rates would be in the fives if the cap were 9% for the last 30 years. What does that mean? Is that good? Is it bad? It's clearly it's lower than what the market would have gotten, right? But it's also achieved without any risk to principal. So the whole purpose of any IUL is not to capture the index rate of return. It's to simply capture a premium over the debt market rate of return that they would have achieved. Because remember, the earnings on their debt portfolio is what they credit to the policy in terms of a dividend. And the insurance company's goal is to achieve as high a growth on the cash value as they can get so as to minimize their risk, which I had illustrated in that graph. So I had gone online and checked the Moody's corporate bond yield today, and it's 2.41%. So the Moody's corporate bond yield is a good proxy for what high quality debt is earning today. And I would estimate, insurance companies are probably earning a higher rate of return than that, but the return on their debt portfolio is what gives the insurance company the budget with which to purchase these options. So what the insurance company is trying to do is not match the return on the market index, it's to simply earn a premium over what they would have received on the cash value. So if we think of 2.41 as being the return that they would have received in the debt markets, and we can earn a 5 to 6% return by hedging, you can see that that's quite a premium over the current debt market rate of return. And that's the whole goal of an IUL, is to capture that premium so that the cash value grows at a faster rate. All right, so the second takeaway that I want you to understand is because the cash value of an Indexed Universal Life will likely grow at a faster rate than a similarly designed whole life, there's going to be less net amount at risk in an IUL compared to a similarly designed whole life. The policies may start off the same. You could have the same age insured, same rate class, same premium, same death benefit. But if the cash value of the IUL is going to grow at a faster rate over time, there's going to be less risk exposure in that policy. And there's also going to be less expense because less insurance needs to be bought or money needs to be pooled in order to cover the claims. So I hope that's clear. So lastly, I want to look at maximum overfunded policies. And this is probably the biggest misconception about the rising cost of mortality. And as soon as I dive into this, you'll see why that is. So when we're doing the double play and you're leveraging the cash value of a life insurance policy for investing in real estate, you're not messing around with those minimally funded policies that I've kind of talked about up to this point. We want a policy that has as much cash value and as little expense in it as we can, because the expense, the high death benefit, is what consumes the cash value. So we want to keep that to an absolute minimum. So I've shown this graph, many times in my videos. This is a 45-year-old putting in $100,000 a year of premium for 10 years. And in a maximum overfunded life insurance policy, the death benefit is determined by the first year's premium. So we're solving, or the software is solving, for the lowest legal death benefit that you can possibly have and still meet the definition of life insurance with that $100,000. And then each year, as the client or policy owner puts more premium into the policy, the resulting cash value is pushing up that minimum amount of death benefit by the amount of new cash value each year. So in order to preserve the cash value, once that policy owner is done putting premium into the policy, in this case 10 years, we need to drive the cost out of the policy. Now, mind you, this is true for both whole life and IULs. There's no label on this graph showing that this is IUL or whole life. This is how they both look. So even in a whole life, the way we do a maximum overfunded policy is we couple a term policy to a traditional base policy or traditional whole life policy. And it's that term policy that raises the death benefit that allows for you to put much more cash into the policy in the form of paid up additions. So even in a whole life, you've got rising costs of mortality over time. That cost needs to be eliminated, or it could cause the policy to lapse. So whether it's a whole life or whether it's an IUL, when you're done putting premium into a policy, you need to slash the death benefit in order to drive the cost out of the policy. And here that's occurring at the 10-year mark, and you see that the orange line representing the death benefit drops off dramatically at that point in time, and the net amount at risk to the insurance company is represented by that little sliver that you see between the orange line and the blue line from year 11 onward. So there's very little risk in a maximum overfunded policy compared to the risk that you saw in that minimum funded policy, where the cash value growth is occurring in an exponential manner over time, ultimately reaching the death benefit. So that policy has much more risk in it compared to this one, where it's the absolute bare minimum amount of death benefit protection. All right, so it's one thing to look at this graph and see that that sliver is very narrow, but what I really want you to see is, let's look at some real numbers, because this is where the rubber meets the road. And it's one thing to speak in hypothetical terms, and it's like, yeah, I can kind of see that, but you really want to see it, right? So let's take a look at this graph, which is really showing you all of the policy expenses in an IUL. Now, mind you, this example is built differently. This is a policy where policy owner is putting in $20,000 of premium for 20 years. Now, mind you, this illustration is different from what we talked about earlier, the 10 years of $100,000. This is a 40-year-old that's putting in premium, $20,000 of premium every year for 26 years. And then at that 26th year, you'll notice that the death benefit drops off dramatically. So it's following the same formula. It's just that it's designed a little bit differently. So I just wanted to show you that it applies to all policies, not necessarily the maximum overfunded with 5 or 10 years of premium. So here, what I want you to take note of is the fees are itemized. And all of these fees are known, and they're in the illustration, and they're based on the amount of premium that you're paying, they're based on the insurance cost, and they're based on the amount of death benefit protection that you have. So they're known. Off on the right, under the green headers, are 2 columns. One is taking a look at the policy expenses as a percentage of the premium. So in many of my videos, you've heard me say that you know your policy is designed properly when the cash value to premium ratio is about 85%. So here we're looking at the flip side of that. If you look at the total expenses as a percentage of the premium, you can see that it's roughly 15%. And if you look down that row from the first 25, 26 years, you can see that it's roughly 15%, give or take, each year. Now, once we slash the death benefit at the end of the 26th year and we drive the cost out of the policy, I want you to take a look at the lower right corner and look at the ratio of costs as a percentage of the total cash value. And what you're going to find is that it's well below 1/4%. Though that's the total insurance cost as a percentage of the cash value in the policy. And that number should blow you away. I mean, that is much lower than most people think the cost in a policy is. And here's what I really want you to understand. That ratio doesn't change. This graph only goes up to age 74 for the insured. But keep in mind that I could run this out to age 120, and that number wouldn't change that much. And the reason for that is the way the definition of life insurance works is that some percentage of the cash value has to be spent on death benefit protection. It doesn't say how much or what the cost of that death benefit protection is. It's just that some percentage needs to be spent on death benefit protection. So everybody will say, oh, well, the cost of insurance isn't guaranteed in an IUL. Well, it doesn't matter. You're still spending the same amount of money on something that increased in price. So what does that mean? You buy less of it. So if by some fluke the mortality tables changed and the death rate among 65-year-olds tripled, so out of 1,000 65-year-olds, the death rate per 1,000 has tripled. So that would mean that the cost of insurance on 65-year-olds would triple as well. So here, we're still spending the same amount of money on that insurance for that 65-year-old. It's just we're just buying 1/3 the amount that we would have purchased before. So the total death benefit goes down, but the total cost or load on the policy stays the same. Now, this is an important takeaway, and I really hope that you understand what you're looking at here. The cost of insurance is not going to impact a maximum overfunded life insurance policy. What I'd like to add is that it is possible for the rising cost of mortality to cause a policy to lapse. Like if you take a look at that 10-page example earlier, if that person did not lower that death benefit, they would have had that extra increment of $2.5 million going out well into the future where the cost of insurance is going up dramatically. And the cost of providing a death benefit of $2.5 million on an 80-year-old is much more costly, and that would cause a policy to lapse. So I guarantee you, given all the horror stories you've ever heard about Indexed Universal Life, you can always find a situation where it was preventable. Had that policy owner slashed the death benefit, they could have taken the cost out. But most of the people, once they have that death benefit, they don't want to get rid of it. So the flip side of that is if the cost of insurance is rising and it's consuming your cash value, and the cash value is not earning enough to keep up with it, you've got to put more money into the policy. So, all right, so let's wrap things up here. There are 3 main takeaways that I want you to get out of this presentation today. One is I just wanted to bust the myth that the rising cost of mortality will cause an IUL to lapse. The reality is that all permanent life insurance policies face rising costs of mortality. And the way that they deal with that is by having the cash value or the savings component. So the policy owner is quite literally saving up their own death benefit over the course of their saving up the death benefit for the insured over the insured's life expectancy. So the amount at risk is going down every year while the cost of insurance is going up. And that is maintainable. And that's true for both whole life and for indexed universal life. But taking it one step further, because the cash value of an indexed universal life will grow at a higher rate than the cash value growth in a whole life, a similarly designed whole life, there will be less amount at risk in an IUL compared to a similarly designed whole life. So there's actually less risk in an IUL. And lastly, when you're talking about a maximum overfunded policy, because the amount spent on insurance is a percentage of the cash value, the rising cost of mortality does not have any impact. It's still the same percentage of cash, the same amount of cash that's being spent on death benefit protection. So it's just an absolute myth that the rising cost of mortality will cause a policy to lapse. So with that, I'm done with this presentation. If you'd like more information and you're not ready to talk to an agent yet, I highly recommend going out to Facebook and joining my Double Play group. It's a community of individuals who are doing this or are interested in doing this. Not everybody's my client. There are people who come to this just because they've already got a whole life from some other agent and they want to learn how this works. So go there, take advantage of the forum, post your questions, look for the expertise of the other individuals. Otherwise, if you go to my website, you'll find that there's a treasure trove of information on life insurance and the Double Play. I've tried to answer every possible question that people can think of, every question that I've ever been asked over the years. So if you can't find it, your last ditch effort is to give me a call. There's a link to see my calendar and set up an appointment with me. I'm happy to answer questions. Take advantage of that. So with that, don't forget to subscribe if you like my content and you find it valuable. You'll be notified whenever I come out with new videos. Be sure to share this video on your favorite social media platforms. Share it with anybody else you think might be interested. And I will see you in the next video.